Okay, hello and welcome everyone to the show. I'm Murph, and as always, I'm here with the ever-calm, ever-analytical Cooper.
It's great to be here, Murph. And hello to everyone listening.
Cooper, we have a massive topic today. It's one that's been in the headlines for years, something that people either think is a total scam or the single most important invention since the internet. We're talking about Bitcoin. We're talking about cryptocurrency.
And it's a topic worthy of a deep dive. The noise around it can be deafening, but underneath the price charts and the hype, there is a fundamental technological and philosophical shift happening.
Absolutely. And before we jump into the rabbit hole, and trust me, it is a deep one, we have to say our obligatory but very important line: nothing we discuss here today constitutes financial advice. We are not financial advisors. This is a conversation for educational and entertainment purposes only. Please do your own research before making any financial decisions.
Couldn't have said it better myself. Think of this as a map of the territory, not a recommendation on where to build your house.
A map of the territory, I like that. So, where does the map start, Cooper? To really understand what Bitcoin is and why it even exists, where do we have to go?
We have to go back to a very specific moment in time, 2008. The world was in the throes of a global financial crisis. Lehman Brothers had just collapsed. Trust in the entire banking system and the institutions that were supposed to be the bedrock of our economy was evaporating.
I remember that. It was scary. People were losing their homes, their life savings. There was a real sense that the people in charge, the ones pulling the levers, had failed spectacularly.
Exactly. And in that environment of profound distrust, on October 31st, 2008, a white paper was quietly posted to a cryptography mailing list. It was titled Bitcoin, a peer-to-peer electronic cash system. The author was a name nobody had ever heard of, Satoshi Nakamoto.
The ghost. The legend. To this day, we still don't know who Satoshi is, right? It could be a person, a group of people nobody knows.
That's correct. And that anonymity is a feature, not a bug. Satoshi wanted the project to stand on its own merits, without a figurehead or a single point of failure. The paper laid out a system for people to send money directly to each other, anywhere in the world, without needing a bank, a credit card company, or any intermediary.
Okay, so break that down. How is that even possible? If I send you money online, I use my bank app or PayPal or something. There's always a company in the middle making sure the transaction goes through.
And that's the genius of it. Satoshi solved the problem that computer scientists had been struggling with for decades, called the double spend problem. In the digital world, anything can be copied. If I have a digital dollar, what stops me from copying it and spending it in two different places at the same time?
Right. My bank solves that. They have a central ledger. They see I spend the dollar here, so they debit my account, and I can't spend it again.
Precisely. The bank is the trusted central authority. Satoshi's solution was to create a decentralized ledger, a public record of every single transaction that has ever happened. We call this a blockchain. Instead of one bank holding the ledger, thousands of computers all over the world hold a copy of it.
So it's like a giant Google Doc that everyone can see but no one can change.
That's an excellent analogy. Every 10 minutes or so, a new block of transactions is added to the chain. And to add that block, these computers, which we call miners, have to solve an incredibly complex mathematical puzzle.
A puzzle? Why?
This is the core of Bitcoin security, a concept called proof of work. By forcing miners to expend real-world resources, in this case, massive amounts of computational power and electricity to solve this puzzle, it makes it practically impossible and prohibitively expensive for anyone to go back and alter a previous transaction. To change the history in that shared Google Doc, you'd have to redo all the work for every single block that came after it, and do it faster than the entire rest of the network combined.
That sounds impossible. So the energy use we hear so much about, that's the security. It's the cost of keeping the network honest without a central boss.
That's it exactly. It's a trade-off. You trade electricity for decentralized, trustless security. And once that new block is added, all the computers on the network update their copy of the ledger. It's this consensus, this agreement among thousands of independent participants that validates the transactions, not a single company.
Wow. So when Satoshi released this on January 3rd, 2009, by mining the first block, the Genesis block, what was the reaction? Did the world immediately see its genius?
Not at all. It was met with curiosity by a very small group of people, cypherpunks, cryptographers, people who had been trying to create digital cash for decades. They saw the elegance of the solution. For everyone else, it was a complete non-event. For the first year, Bitcoin had no monetary value. It was just a fascinating experiment.
So people were just mining it on their laptops for fun?
For fun, for the intellectual challenge, and because they believed in the idea. The first ever real-world transaction is now legendary in the space. On May 22, 2010, the programmer named Laszlo Hanieks offered 10,000 bitcoins to anyone who would order him 2 pizzas.
The Bitcoin Pizza Day. I've heard about this. Someone took him up on it, and he got his pizzas. Those 10,000 bitcoins would be worth what? Hundreds of millions of dollars today.
Depending on the day, yes. It's a funny story, but it's also a profoundly important moment. It was the first time Bitcoin bridged the gap from a digital curiosity to something with real-world purchasing power. It established the first, albeit tiny, price point.
But it was still very niche. When did it start to get its more infamous reputation? I'm thinking of things like the Silk Road.
That was the next major phase. The very features that made Bitcoin revolutionary, its pseudonymity, its censorship resistance, its ability to be sent anywhere without permission, also made it attractive for illicit activities. The Silk Road was an online black market on the dark web, and Bitcoin became its currency of choice.
Which, for a lot of people, cemented the idea that crypto was only for criminals.
It certainly created that narrative, and it's one the space has been fighting to shed ever since. The FBI eventually shut down the Silk Road in 2013 and seized its bitcoins. But ironically, that event had an unintended consequence. It proved that Bitcoin wasn't completely anonymous, it was pseudonymous. The public ledger, the blockchain, could be analyzed. And it also showed that Bitcoin couldn't be shut down. They could arrest the people using it, but the network itself just kept on running, adding a new block every 10 minutes, unstoppable.
So after the Silk Road era, what happened? The price started to move around this time, right? The first big bubbles.
Yes. Around 2013, we saw the first real speculative bubble. The price shot up from around $13 to over $1,000 in a single year, driven by media attention and speculation, primarily from Cyprus, where there was a banking crisis and people were looking for ways to get their money out of the system.
A classic use case, escaping a failing financial system.
A perfect use case. But of course, what goes up that fast tends to come down. And it did. The bubble burst, and then came a catastrophic event for the community, the collapse of NT. Gox?
Mt. Gox. That was the big exchange, right? The main place to buy and sell Bitcoin back then.
It was *v* exchange. It handled something like 70% of all Bitcoin transactions at its peak. In early 2014, it went offline, claiming it had been hacked and had lost hundreds of thousands of Bitcoins belonging to its customers. It was a disaster. It wiped out fortunes and shattered trust, not in Bitcoin the protocol, which kept running perfectly, but in the centralized companies built around it.
So that was a key lesson. Bitcoin the network is secure, but the companies you use to interact with it might not be. Not your keys, not your coins became the mantra.
Exactly. It forced a painful but necessary maturation. The price crashed by over 80% and entered a long, cold crypto winter. Many people wrote Bitcoin off for dead. Again. But the developers kept building. The believers kept believing. And during this quiet period, a new idea was taking shape, one that would arguably become just as important as Bitcoin itself.
And that would be?
Ethereum.
Add the silver to Bitcoin's gold, as some people say. This is where things start to get more complicated than just digital cash, right?
Infinitely more complicated and infinitely more ambitious. In late 2013, a brilliant young programmer named Vitalik Buterin, who had been a writer for Bitcoin magazine, published the Ethereum white paper. He argued that the blockchain concept was too powerful to be used for just money.
What did he mean by that?
Vitalik looked at Bitcoin's blockchain and saw its scripting language was very basic, deliberately so, for security. It could really only do one thing, process Bitcoin transactions. He envisioned a new blockchain with a much more flexible and powerful programming language. A blockchain that could run not just transactions, but complex applications and agreements. He called this concept smart contracts.
Smart contracts. I hear this term all the time. Break it down for me like I'm 5.
Okay. Think of a vending machine. A normal contract is me saying, Murph, if you give me $1, I'll give you this can of soda. There's trust involved. You have to trust that I'll give you the soda after you give me the $1.
And I have to trust it's the right soda and not expired.
Right. A smart contract is the vending machine itself. The terms of the agreement: if $1 is inserted, then dispense 1 can of soda are written in code. You put the $1 in, the machine automatically verifies the condition has been met, and it executes the outcome. It asterisk is asterisk to give you the soda. There's no trust needed, you're trusting the code.
So a smart contract is just a piece of code that runs on the blockchain and automatically executes an agreement when certain conditions are met?
Precisely. And Ethereum was designed to be a decentralized global computer for running these smart contracts. Suddenly, the possibilities exploded. You could create decentralized versions of almost anything. You could code financial instruments like loans and insurance that operate without a bank or insurance company. You could create voting systems, supply chain management systems, social media platforms, all running on this shared global computer, the Ethereum virtual machine, or EVM.
So Bitcoin is like a calculator designed to do one thing really well, which is math, or in its case, money. But Ethereum is like a smartphone. You can still use it as a calculator, but you can also download thousands of different apps that do all sorts of other things.
That is a perfect analogy. And those apps are what we call DApps, or decentralized applications. This new potential kicked off the next massive wave of interest in crypto. In 2017, we had the ICO boom.
Oh boy, the initial coin offering craze. I remember this. It felt like every day there was a new project with a fancy white paper promising to revolutionize some industry, raising millions of dollars in minutes.
It was the Wild West. The idea was that instead of selling stock like a company, a project would sell its own unique crypto token that would be used in its DApp. People bought these tokens hoping they would be the next Bitcoin or Ether, the native token of Ethereum.
And most of them were, let's be generous and say, not great ideas. A lot of them were outright scams.
A huge number of them were. It was a period of rampant irrational speculation. The price of Bitcoin soared to nearly $20,000, and Ethereum hit its own highs. The mainstream media went into a frenzy. Everyone and their grandmother was talking about crypto, but the underlying technology wasn't ready for the hype. The Ethereum network got congested, fees skyrocketed, and most of these ICO projects eventually failed to deliver and went to zero.
And then came the next great crypto winter, 2018. Another massive crash. Bitcoin fell over 80% again. The I told you so's were deafening.
They were. And once again, the tourists left, the speculators got burned, and the narrative became crypto is dead. But just like after the NT, Gox crashed, the serious builders stayed. And this time, they weren't just building infrastructure. The seed planted by Ethereum smart contracts began to sprout into two incredibly powerful movements, DeFi and NFTs.
Okay, two more huge acronyms. Let's start with DeFi. Decentralized finance.
DeFi is the idea of rebuilding the entire traditional financial system, lending, borrowing, trading, earning interest, but without the centralized intermediaries. Using smart contracts on Ethereum, developers built protocols that let you do these things directly from your own crypto wallet.
So instead of going to a bank for a loan, I could put up some of my crypto as collateral into a smart contract and borrow against it from a pool of liquidity provided by other users.
Exactly. And those other users who provide the liquidity earn interest on their assets. It's all peer-to-peer, governed by code. No loan officers, no bank opening hours, no one who can deny you service based on who you are or where you live. As long as you have the collateral and an internet connection, you can participate. This was a quantum leap.
That sounds incredibly powerful. Taking the middleman out of finance. But also incredibly risky, I imagine. If there's a bug in the code,
your money is gone. And that has happened many times. The space is still very much in its experimental phase. But the potential is enormous. And at the same time DeFi was growing, the other seed, NFT, started to bloom.
Non-fungible tokens. The digital pictures of apes and punks they're sold for millions of dollars. A lot of people really struggle to understand this one. Why would anyone pay so much for a JPEG you can just right-click and save?
It's a common and understandable point of confusion. And it comes from a misunderstanding of what the NFT is. You're not buying the image, you're buying the provably scarce, unique token on the blockchain that points asterisk to that image. It's about proving ownership.
So it's less about the art and more about the receipt? The deed of ownership?
Precisely. Anyone can buy a print of the Mona Lisa, but only the Louvre owns the original. The NFT is the digital equivalent of that original's unforgeable provenance, recorded forever on the blockchain. The initial craze focused on digital art and collectibles, like with CryptoPunks and Bored Ape Yacht Club, which became status symbols. But the underlying technology of unique digital ownership has applications far beyond that.
Like what? What else can you own with an NFT?
Think about concert tickets. Today, scalpers are a huge problem. With NFTs, the artist could program the ticket so it can only be resold for a certain price, or so that they get a percentage of every resale forever. Think about in-game items. You could truly own the sword or skin you earn in a video game and take it to another game or sell it on an open market. Think about real estate deeds, stock certificates, diplomas, your own personal data. Anything that needs a unique, verifiable record of ownership can be an NFT.
Okay, that makes a lot more sense. The JPEG craze was just the first, most visible and maybe silliest application of a much more profound technology.
That's how I see it. And this explosion in DeFi and NFTs in 2020 and 2021 fueled the next massive bull run. Bitcoin soared to over $69,000. But this time, something was different. It wasn't just retail speculators and crypto natives. The institutions were starting to arrive.
Right. This is where the story shifts from being about nerdy outsiders to Wall Street insiders. Who were the first big players to make a move?
One of the most prominent was Michael Saylor, the CEO of a software company called MicroStrategy. In August 2020, he announced his company was going to start converting its cash reserves into Bitcoin, calling it a superior treasury reserve asset to cash. It was a bold, almost shocking move at the time.
He basically turned his company into a Bitcoin holding company.
In effect, yes. He saw Bitcoin not just as a currency or speculative asset, but as a long-term store of value, an antidote to the monetary inflation he saw coming as governments printed trillions of dollars in response to the pandemic. He was followed by others. Paul Tudor Jones, a legendary macro investor, announced he was allocating a portion of his fund to Bitcoin. Tesla famously bought $1, $5 billion worth. El Salvador even made it legal tender.
The institutional dominoes started to fall. But this also brought up the old criticisms again, louder than ever. Especially the energy consumption debate.
Absolutely. As the price and the network's hash rate hit new highs, the environmental, social, and governance, or ESG, concerns became a major narrative. This is where the distinction between different cryptocurrencies becomes vital. Bitcoin's proof of work is energy intensive by design. That's its security model.
But other cryptos were trying a different approach, right?
Correct. The main alternative is cold proof of stake. Instead of miners expending energy to validate transactions, validators lock up or stake a certain amount of the network's native currency as collateral. If they act honestly and validate transactions correctly, they get rewarded. If they act maliciously, they risk having their stake collateral slashed or taken away.
So instead of securing the network with energy, you're securing it with economic incentives. You have skin in the game.
Exactly. It's a different security model with a much smaller energy footprint, over 99% less in some cases. And the biggest event in this sphere was in September 2022, when Ethereum, the second largest cryptocurrency, successfully transitioned from proof of work to proof of stake. It was a monumental engineering feat known as the merge.
So that addressed a huge part of the energy criticism, at least for the ecosystem being built on Ethereum. But what about Bitcoin? It's still proof of work.
It is, and it likely always will be. The Bitcoin community values security and decentralization above all else, and they see proof of work as the most battle-tested way to achieve that. The counter-arguments from the Bitcoin side are that a lot of the energy used is from renewable sources or stranded energy that wouldn't be used otherwise, and that the energy is not wasted but is being used to secure a global, open financial network, which is an incredibly valuable service.
It's a fascinating debate. And there's another big problem that came to the forefront during the last bull run: scalability. The networks get slow and expensive when everyone tries to use them at once.
This is known as the blockchain trilemma. The idea is that it's incredibly difficult for a blockchain to be simultaneously decentralized, secure, and scalable. You usually have to compromise on one. Bitcoin and Ethereum prioritize decentralization and security, so they struggle with scalability. A single block of Bitcoin transactions happens every 10 minutes. Visa can handle tens of thousands of transactions per second.
You can't run a global coffee economy on that.
Not on the base layer, no. And this is where the next major area of innovation is happening: Layer 2 scaling solutions. These are protocols built asterisk on top asterisk of the main blockchain, the Layer 1. They process transactions off-chain quickly and cheaply, and then bundle them up and settle them on the main secure Layer 1 later.
So it's like having a bot app. Me and you can buy each other drinks all night, marking it down on a separate tab. We do dozens of little transactions. Then at the end of the night, we just settle the final amount with the bar. The main ledger, the bar's cash register, only has to record one final transaction instead of 50 small ones.
That is a perfect analogy. For Bitcoin, the most well-known Layer 2 is the Lightning Network, which allows for near-instant, near-free Bitcoin payments. For Ethereum, there are various types of rollups that are processing millions of transactions for pennies. This is how crypto plans to scale to billions of users.
Okay, so we've covered the history, the tech, the booms, the busts, the major problems, and the solutions being built. Which brings us to today. Right now. After the 2021 peak, we had another brutal bear market in 2022, with major companies like Celsius and FTX collapsing in spectacular fashion.
The FTX collapse in particular was devastating. It was a repeat of the MT. Gok's lesson on an even grander scale. It wasn't a failure of crypto, it was a failure of a centralized company and, frankly, old-fashioned for all. But it set the industry back significantly and invited intense regulatory scrutiny.
And yet, despite that, the biggest event in crypto's institutional adoption happened just after that, in January 2024. Talk to us about the spot Bitcoin ETFs.
This is the holy grail for many in the space for a decade. An ETF, or exchange traded fund, is a financial product that trades on a stock exchange, like the New York Stock Exchange. A spot Bitcoin ETF holds actual Bitcoin and allows anyone with a regular brokerage account to get direct price exposure to Bitcoin without having to worry about self-custody, private keys, or signing up for a crypto exchange.
So my dad, who knows how to buy stocks in his retirement account, can now buy a product from a company he trusts, like BlackRock or Fidelity, and it's backed by real Bitcoin.
Precisely. And BlackRock, the world's largest asset manager with trillions of dollars under management throwing its weight behind a Bitcoin ETF, was a seismic shift. The US Securities and Exchange Commission (SEC) had denied applications for a decade, but after a court ruling went against them, they finally approved a slate of them. It was a massive moment of validation. It legitimized Bitcoin as a macro financial asset in the eyes of the traditional world.
It's no longer a question of asterisk if asterisk institutions will adopt it, but asterisk how quickly asterisk. So this is the point we pivot. We've seen the history. Now let's talk about the title of our episode. How will this technology, this code, actually revolutionize humanity? Let's get into the bigger grand vision.
I think it starts with the most fundamental use case, money. There are about 2 billion people in the world who are unbanked or underbanked. They don't have access to basic financial services, but many of them have a mobile phone. Bitcoin and other cryptocurrencies give them the ability to be their own bank, to receive money, to store it securely, and to send it without needing permission from anyone.
That's huge. We take our banking for granted, but for someone in a developing country, getting a payment from a relative abroad can mean losing a huge percentage to fees and waiting days. With something like the Lightning Network, it could be nearly instant and cost a fraction of a penny.
It's a game changer for remittances and economic empowerment. But it's not just for the unbanked. It's also for the citizens of countries with hyperinflation. Think of Argentina, Venezuela, Turkey, Lebanon. Their currencies are collapsing, and their life savings are being wiped out. For them, Bitcoin isn't a risky speculation, it's a lifeboat. It's a savings technology that the government can't print into oblivion.
Because there will only ever be 21 million Bitcoin. It's written in the code. That's the hard cap.
That programmatic, predictable scarcity is its core value proposition as a store of value, or what some call digital gold. Unlike gold, however, you can send $1 billion worth of it to the other side of the world in minutes with just an internet connection. It's a global, incorruptible savings technology.
Okay, so that's the revolution in money and finance. What about beyond that? You mentioned NFTs and ownership.
This is where it gets even more profound. We are moving into an increasingly digital world. What does it mean to own something online? Right now, you don't really own much. You don't own your social media profile, the company does. You don't own the movie you buy on a streaming service, you're just licensing it. NFTs create a paradigm of true, verifiable digital property rights for the first time.
So the revolution is in the concept of ownership itself. My digital life can become something I truly possess, not just rent from giant corporations.
Exactly. And that extends to identity. Right now, your digital identity is fragmented across dozens of companies: Google, Facebook, your bank, your government. They hold your data. A system of self-sovereign identity built on crypto principles could allow you to have a single, secure digital identity that you control. You own your data, and you grant companies temporary specific access to it only when you choose.
No more logging in with Google or Facebook. I just log in with my own decentralized ID. That's a massive privacy revolution.
A massive one. And then there's the revolution in how we organize. We talked about smart contracts. That has led to the rise of DAOs, or decentralized autonomous organizations.
It sounds like something from a sci-fi movie.
It kind of is. A DAO is like a company or a community that is run by code and by the collective decisions of its members. The rules are encoded in smart contracts, and decisions are made by members voting with governance tokens. The treasury is held on the blockchain, completely transparent to everyone.
So it's like a corporation with no CEO and no board of directors, just a set of rules and a community of token holders who vote on everything.
That's the idea. It's a new way for humans to coordinate the managed share of resources, from investment funds to social clubs to software projects. It's still very early and clunky, but it's a radical experiment in digital governance.
All of these things, the money, the ownership, the identity, the governance, they all seem to point to one central theme: decentralization. Taking power away from trusted third parties and giving it back to the individual.
That is the core philosophical thread that runs through everything. And it leads to perhaps its most controversial and important potential use case: a tool for freedom. In authoritarian regimes, governments can and do freeze the bank accounts of dissidents. They censor platforms and shut down access to information.
But they can't shut down Bitcoin. And they can't freeze a Bitcoin wallet if you control your own private keys.
Correct. It is censorship-resistant money and, increasingly, with DApps, censorship-resistant communication and organization. We saw this in Canada during the trucker protests, when the government froze bank accounts and crypto became a way for people to receive donations. We see it with activists in Nigeria and Belarus. It's a tool that provides a check on absolute power.
That's a powerful statement. But it also leads us directly into the future, and the biggest battle on the horizon, the one with governments and regulators. They're not just going to let this parallel system go unchecked, or are they?
Unlikely. The future of crypto will be defined by its relationship with the state. We're seeing this play out right now. In the US, the SEC has been pursuing a strategy of regulation by enforcement, suing exchanges and projects. In other places, like Dubai or Switzerland, they are creating clear regulatory sandboxes to attract innovation.
So it's a global regulatory arbitrage where projects will move to the friendliest jurisdictions.
To some extent, yes. But the big question is, what will be the ultimate response of the world's major powers? And this is where we see the emergence of a competing vision, central bank digital currencies, or CBDC.
The anti-Bitcoin. The state-controlled digital dollar or digital yuan.
Exactly. A CBDC would be a digital currency issued and controlled by a central bank. It would be efficient, yes, but it would also offer the state an unprecedented level of control and surveillance over its citizens' financial lives.
They could see every transaction you make, and the money could be programmable. They could say, this money can only be spent on groceries, or this stimulus payment expires in 30 days, or even freeze your funds with a click of a button if you say something they don't like.
It's the dystopian potential of this technology. So the great battle of the coming decades may be between two visions of our digital future, the open, permissionless, decentralized vision of cryptocurrencies like Bitcoin, and the closed, permissioned, centralized vision of CBDC.
That's a chilling thought. It really frames the stakes. It's not just about getting rich, it's about what kind of society we want to live in.
It is. The technology is a tool. It can be used to empower, or it can be used to control.
So, looking ahead, what other future trends do you see? What about the intersection of crypto with other emerging technologies, like AI?
That's one of the most exciting frontiers. Imagine AI agents that need to transact with each other. They'll need a native currency of the internet that is programmatic and doesn't rely on the slow, analog traditional banking system. Crypto is the perfect solution. They could have their own wallets, earn their own money, pay for their own computational resources.
So AIs will need their own banks, and crypto will be that banking layer for the machine economy.
Potentially. You could also see decentralized AI models, where instead of a model being owned by one company like OpenAI or Google, it's run and trained by a network of participants who are compensated in crypto. This could prevent the concentration of AI power in the hands of a few giant corporations.
That's mind-bending. So what does mass adoption look like in the end? Will my grandma need to learn how to manage private keys and use a hardware wallet?
I don't think so. Mass adoption will look like nothing. It will be invisible. Just as you don't need to know how TCP/IP works to browse a website, you won't need to know how the Lightning Network works to make a payment.
It'll be abstracted away behind user-friendly apps. I'll just tap my phone to pay for coffee, and in the background, a complex series of transactions might be happening on layer 2s, but I won't see or care about any of it. I just know it worked.
That's the end goal. The technology will be so seamless it fades into the background, just like the internet did. You'll interact with NFTs without calling them NFTs, it'll just be your concert ticket in your Apple Wallet. You will use DeFi without calling it DeFi, it'll just be a high-yield savings account in your banking app that's actually powered by a decentralized protocol on the back end.
So, after this incredible journey from the 2008 crisis through the pizza and the dark markets, the ICOs and NFTs, the crashes and the institutional embrace, what's your final takeaway, Cooper? When you boil it all down, what is the most important thing for people to understand about this space?
That it's still so early. We're still in the dial-up phase of this new internet of value. It's volatile, it's risky, and it's complicated. There will be more scams, more crashes, and more political battles. But the core innovation, the ability to have a global, open, decentralized, and verifiable record of truth and ownership is too powerful to ignore.
It's a fundamental building block for a new kind of digital world.
Exactly. Bitcoin started as a what if. What if we could create money that no one controls? And that single question has now blossomed into 1,000 more. What if we could create organizations no one controls? What if we could create a digital world that we truly own? We're only just beginning to see the answers. And it's going to be a wild, fascinating, and incredibly important ride.
I couldn't agree more. It's about so much more than the price. Cooper, thank you. This has been an absolutely epic exploration.
The pleasure was all mine, Murph.
And thank you to everyone for listening. We hope this has given you a clear map of this wild and wonderful territory. Until next time, stay curious.